Thank you, Jeremy. Yeah, let's go ahead and get started. I know people are still coming on in, but we'll do some introductions first before we get into the meat of the webinar. So, welcome everybody who's attending today's webinar. This is First Street's webinar on the insurance bubble. For those of you that are new to First Street, we're a 501c3 nonprofit, and we're dedicated to making climate change risk information accessible and actionable to individuals, businesses, and governments across the U.S. And you can check out, you can see behind us on our screen, you can also see riskfactor.com. That's our public-facing consumer tool where you can learn about your climate risk at any address in the US. Type in your address and you'll see all this information that we'll be talking about today. So I'm Dr. Ed Kearns. I'm the Chief Data Officer at First Street. I lead our data and science teams at First Street that create these products. And I'll let Dr. Jeremy Porter introduce himself.
Yeah, hey, everybody. I'm Dr. Jeremy Porter. I'm the head of climate implications research here at the First Street Foundation. I usually lead the development of the reports, the national reports that we release that we'll be going through here. And then Ed leads all of, as he said, all of our science development. So he'll be able to speak directly to the hazard models and the science behind those models. So between the two of us, we should be able to kind of walk through the report, tell you a little bit about the data behind the report, the implications that we found in the report, but then answer questions as they come in. And I think there are a couple of housekeeping issues. We are going to be recording the webinar, so that it'll be available afterwards. So we'll release that. But also we're going to be collecting questions. So you can send questions along to us. We'll collect them. We'll be able to respond to some of them at the end. We won't be able to respond until the end of the Q&A session, but we will follow up as we release the recording with answers to questions also. So there's a couple thousand people that registered for the webinar, so we're not going to be able to get to everybody's questions, but please send along questions. We'll sort of curate them on our end and try to respond to them as we're able to.
Yeah, thanks, Jeremy. And we will send the slides that Jeremy will be presenting. We'll send that copy out to all of you too. I'll make that available. So let's get started. So we're talking about the insurance bubble today, and so in particular, a lot of the impacts on wildfire on insurance. Wildfire, as many of you know, is the fastest growing natural disaster in the U.S. today. Over the last couple of decades, there's a lot of interannual variability. We've seen about 70% increase in the number of acres burned over the last 10 years. And this is despite a lot of federal spending towards suppression, almost $1.6 billion a year to try to combat wildfires. But wildfires continue to increase in the number of them and how many acres they are burning across the U.S. These data are from our collaborators at Headwater Economics and the U.S. Forest Service. Next, please, Jeremy.
Yes.
So with the increase in the acres burned, of course, the number of structures being exposed to that wildfire risk is increasing. And so the number of structures destroyed each year is skyrocketing also. Looking at, no matter how you measure it, looking at NOAA's billion-dollar disaster list from Adam Smith at NOAA NCI, you can see the uptick in losses over the years. Again, despite the variability that you look at the overall trend, it is very stark and very sobering. And so we wanted to try to measure what these increases are going to be, what we can expect to see them into the future.
Yes.
Next, please.
One thing I'll add, Ed, is that one of the things that we pull out of these graphs is that while we're seeing increases in cost and structures burned, we don't see quite as equivalent an increase in acres burned. But what it's telling us is that where these fires are occurring, they're impacting people more often. So we're seeing more impacts between where we've chosen to develop and where we're seeing these hazards.
Yeah, absolutely. Thank you, Jeremy. So how First Street has approached this with our partners at the Pyrogens Consortium, fire scientists there, is that we've created a risk model based upon a wildfire behavior model, which we are running in a deterministic mode over and over again in a Monte Carlo simulation. So we basically create 150 million fires across the U.S. based upon historic ignition locations, see where those fires are likely to burn under a wide range of weather conditions. Then we look at the IPCC's climate models, the CMIP6, the latest version of climate models. We use those models to project into the future how weather is going to be changing into the future, and we run that simulation again. We create another 150 million possible fires across the US, and we look at the difference between what that risk is today and what that risk is going to be in 30 years. So what it allows us to do is create a 30-meter horizontal resolution estimate of what the burn probability and the flame length is going to be across the US. So we've included things like specific calibration pyrome by pyrome. The US Forest Service classifies the US by 128 different classifications. Pyromes, we're using the land fire fuels database from the Forest Service and the Department of Interior as the basis of this work. We use the Forest Service's geospatially variant suppression index. So that's how easy it is to get fire crews in to suppress wildfires in these areas and defend homes and structures across the US. So that's included in the fire behavior model itself. And then we also work with our partners at Arup engineering firm to look at, for different types of buildings, whether it's residential buildings or commercial buildings, what is the likelihood that buildings will ignite or will be lost in these kinds of wildfires. Next, please. And what we're seeing from the results of this model is not that we're expecting to see larger fires or more severe fires in the future, but what we are expecting to see due to increased temperature with climate change going into the future is we're expecting to see forests dry out, fuels dry out faster than they have in the past. And we're seeing more wildfires in these simulations. That's the main thing that's driving up risk. And we're seeing that increased risk result in more acres burned in our prediction going into the future. So Jeremy put this slide together. He knows I went to University of Rhode Island in graduate school, so we're measuring by Rhode Island state. So Little Rhodey is being used as our metric here, but we're going from about 2 million acres burned in 2010. We're seeing about 4 million today. And when our projections are showing, we're seeing that increasing to 6 million in 2037 and all the way to 9 million acres burned in 2052. And again, this is largely the result of more fires as a result of higher air temperatures making fuels more susceptible to burning. Next, please. And as those acres burned, we're also seeing the number of structures expected to burn increasing, almost doubling over the next 30 years. And so one of the things we do in our fire model is we hold the built environment constant. So we're not making any projections about new development. We're holding the development in the future where it is today, so that we can focus on what the climate change impact is in particular. So when we say the increase is going from 17,000 structures expected to be lost today on average to on average 34,000 30 years from now, that is, again, because of the increase in wildfires that are impinging upon the areas today. So again, a good metric, again, with I live in Asheville, North Carolina. This is the equivalent of losing the entire city of North Carolina, or sorry, Asheville, North Carolina every year to lose 34,000 homes. So it's quite a sizable increase.
And one thing I'll point out is that everything to the left of 2022 is a 5-year rolling average. So there are really high years. I mean, bad years in 2017 and 2020. We saw 25,000 structures destroyed, or we saw 17,000 structures destroyed. So just to put it in context, in really bad years, what we're saying is in the future, sort of our average years are going to look like really bad years from our current environment, or just the recent bad years that we've seen in the past few years.
Yeah, very good point. The interannual variability is very high with this. Mm-hmm. And of course, California is the nexus of a lot of this problem right now. So a lot of what we'll be talking about today is focused on the California market. Wildfire and increasing wildfire risk is not just a Western problem. It is emerging risk in the Southeast as well, and across the U.S. But today we'll be focused a lot on the California problem and the insurance industry's challenges that they're facing out there today. So today, we're looking at the forecast. The average number of structures destroyed every year is about 6,700 today, but it's being projected to increase to over 11,000 by 2053. So a 70% increase in the probable number of homes that are going to be lost, structures that are going to be lost to wildfire. And of course, a lot of people are taking very close interest in this. This is affecting the housing industry and the insurance industry. And Dr. Porter will get into more of that now.
Yeah, and I think one of the things to take away from this map is really the spatial variability. You know, the patterns that we see where we see high clusters of this interaction between our underlying wildfire model and the likelihood of burning or the structures that are at risk of combusting. So there's this conditional combustion metric that's made up of property level characteristics associated with the properties that intersects with our actual wildfire model. And we're seeing sort of around the, Southern California, Los Angeles metro area, kind of in the foothills of the Sierra Nevadas, and then in the East Bay area, around the Contra Costa County area. These aren't necessarily the areas with the most extreme wildfire risk, but they are the areas where development and where structures intersect with the high levels of wildfire risk. So those two things together are required to get us to the point of having this average annual structures destroyed metric, which is a really nice metric that we produced that we think aligns relatively well with the way we think about like an average annual loss. It gives us the way to think about losses, damages, destruction annually. We know it's not going to happen every year. When a big fire does happen, it'll be larger than the numbers we're producing, but it does help us identify these places that have dense development and have high wildfire risk. So it ends up informing a lot of what we're looking at in this report, and it really ends up aligning well with what we're seeing in regard to patterns recent policy non-renewals and pullouts in the insurance market. So we'll get back to that in a little bit later, but I wanted to highlight the MAP variability because it does align really well with some of the other data that we see a couple slides down. So as we start to transition it to insurance, we start to think about, what impact is this having on property values? What impact is it having on property owners? One of the things that we have to remember is that when people go to buy a home, one of the core costs that goes into their home ownership, sort of the contract they sign when they decide to sign a 30-year mortgage or a 15-year mortgage, is they know what their principals and interest is going to be. They know what the property taxes are going to be. If there are homeowners association fees, they know what those are. But they also have a pretty good idea of what their insurance is going to be. So there are these core components that go into home ownership, and when people buy those properties, they're signing on to something that they expect that they can afford. And that transition that we start to see, which we'll get into in a couple of slides, where we're adding additional expenditures through increases in insurance premiums, ends up having a disproportionate impact on property values from an asset valuation perspective, but also just from an individual's budget perspective. People, have these monthly expectations. If you see a 500, 400% increase in insurance, there are real quantifiable consequences associated with that. And we'll sort of walk through that a little bit in the report. So in some places, the regulatory policies on the insurance market are relatively strict. This varies across the state. Insurance markets are regulated by the states. In California, for instance, we're focusing at this point on the wildfire risk 2 structures. In the state, there are a handful of things that are regulatory policies. They've been put in place. They've been there for decades, and they're in place to control and sort of protect consumers from rapidly rising insurance costs. So some of the things that exist there are that no adjustments can be made on, no adjustments can be made on climate data. All of the premium pricing generally has to focus on historic observation. It can't take into account current conditions or future facing conditions. The cost of reinsurance can't be brought into the pricing of premiums. As we all know, reinsurers are taking into account the cost of climate. They're taking into account the cost of inflation. Those additional increases are being passed down to the insurance companies, but they're not being able to directly allocate that to premiums within the state based on the regulatory policies. And then the premiums themselves have to be based on sort of a portfolio level of risk. They can't be predicated on the simple risk associated with a single home. They're the kind of easiest way to think about this, or probably the most explicit rule that's been put in place, is that year over year, insurance companies can't raise premiums above 7%. 7% really is the point at which you start to trigger a hearing in the state. It takes the time period associated with actually getting that approval for the additional increase is one of the reasons why you don't see insurance companies oftentimes price above that 7% increase. But as we'll see on the next graph, that 7% increase actually impacts the bottom line of these insurance companies, because it's not able to keep up with actual growing cost of business. So here on this graph, you can see the black line that we first have across the screen. It starts with a hypothetical $2,000 insurance policy. We compounded 7% annually until 2023. So in the best case scenario, you're getting your 7% increase annually. We're compounding that year over year. You end up with about a $4,800 policy. Over that same time, we're seeing increases in inflation from business costs, increases in cost to rebuild, also driven primarily by inflation. We're seeing actual damage increases, so the real outcomes of increased exposure to climate events. But then we're also seeing increases in cost of reinsurance. And as we know, we've seen that relatively dramatically spike over the past couple of years. So if you just take this hypothetical situation in California with just kind of average increases over this time period in these different components, you're seeing about a $3,000 artificial suppression of the premiums. The insurance companies in this case are not able to actuarially price what the premium should be, and what that ultimately means is that we see what we've been seeing in the news. We see insurance companies pulling out. In some cases, they're deciding not to do business in the state. In other cases, it's not necessarily that they're not doing business at all, but they're pulling out of certain areas, or they're placing quotas on the number of policies that they may offer in the area so that they can remain active in the state. But we've seen this. We've seen it over the last 2 or 3 years. And it's primarily driven by those regulatory policies and the increased exposure to climate risk. When the state FAIR Plan was put into place, it was put into place to protect homeowners, and it wasn't always tied to climate and increasing climate. It's become sort of the primary hot button topic at this point. But early on, it was associated with a lot of different social issues and other risk issues that were associated with making sure everyone had access to fairly priced insurance. So this is the data that we pulled from the state of California. And this is when I talked about the map earlier on, and I said, look at the average annual structures destroyed across the state, where we see those hotspots. They were in Southern California, they were in the foothills of the Sierra Nevadas, and they were kind of in the East Bay area. But if we just go and pull data from the state FAIR Plan, this is zip code level data of policy non-renewals that were insurer initiated. We're actually seeing that just by comparing the number of policy non-renewals, insurer initiated policy non-renewals in 2021 versus the number of insurer initiated policy non-renewals in 2015, the same areas that we saw that had the highest level of risk, that intersection of development and wildfire risk from our models, are the same places that insurance companies have been actively pulling out of since 2015. And potentially before that, our data only goes back to 2015. Another really important point is we only have data through 2021 from the state. So we also know 2021 was a bad fire year. The insurance companies started to actively pull out in 2022, 2023, but also we're expecting that there was a tremendous amount of non-renewals that came out in 2022 also. So we're interested in seeing what those numbers look like. They almost certainly increased in the highest risk areas, but this snapshot between 2015 and 2021 gives us the ability to understand, the insurance companies and the folks that are making these risk-based decisions, they have access to this information. They're selectively making decisions based on risk, which makes sense given the business models, but it aligns really, really well with our understanding of what general wildfire risk looks like and how that intersects with population development. And just still from the state FAIR Plan data, all the data was from the zip code level. Here are the top 10 zip codes in regards to the increase in 2021 insurer-initiated policy non-renewals relative to the 2015 number of insurer-initiated policy non-renewals. And in some places like 92325 in San Bernardino County, we saw a huge increase, almost an 800% increase in those non-renewals. We go from about 100 policy non-renewals to over 900 insurer-initiated non-renewals. And that, 900 is a big number, but if you're thinking about a community, you may say 900, non-renewals. That's not a huge number. Maybe, maybe it's just within the regular bounds of business. But if you look at the actual number of properties that are in that zip code, there's only 8,591 properties in that zip code per the Census Bureau, which means that, we're getting to the point here where about 11% of all properties in that zip code in 2021 got a insurer-initiated non-renewal. So this is an area that has a huge amount of risk. 1 in 10 properties is getting a non-renewal letter in the mail. So they're either having to find another insurance company, which almost certainly will increase rates on the policies, or they're having to move over to the state fair plan, which we already know has a higher average premium than do the insurance companies operating in the private insurance market. So these are places you can kind of look at the counties, you can look at the zip codes, you can tell that they end up correlating pretty well with the zip codes that we're seeing here. A lot of Southern California, a lot of the areas in kind of the foothills of the Sierra Nevada, and then kind of the East Bay area. They're sort of popping up, especially the areas around Southern California. We have a lot of really dense population in that area and a lot of really high wildfire risk. So those two things, again, come together to really drive up the way both insurance companies are thinking about concentrations of risk, but also the way that we're thinking about tying that average annual structures destroyed metric to that outcome. So as we started to identify these properties, we started to dig into the insurance data. We started to understand the sort of rate at which we were seeing these insurer-initiated non-renewals. We really wanted to think about how do we translate that to something tangible? How can we start to understand how this is impacting homeowners and sort of their bottom line? So we explored a couple of different routes. Home ownership, as we all know, can be very sentimental. People get tied to their home, they're tied to their communities, they're tied to their kids' schools. So there are sometimes non-rational ways in which people think about home ownership. But if you just were to take an asset valuation approach that an institutional investor would take, you can start to adjust that to a very rational approach, and you can start to price in the impact of these increasing insurance premiums. So we've done that. We've taken that approach. We really just wanted to understand from that asset valuation approach, taking that purely rational approach to understanding the impact of revenues versus expenditures. How can we understand the impact that these rising insurance costs are having on asset values? So to understand that, we have these equations here at the bottom. The current home value, the asset value is just the net operating income divided by the cap rate or the return rate that we expect to have on that asset. The net operating income is simply revenue minus expenditures. And so that gives us the ability to understand how much are we bringing back from that property on an annual basis. And then we can divide that by the cap rate. It gives us sort of an overall valuation metric that gives us the ability to understand if it's a sound investment or not from an institutional investor's approach. If we move to the equation on the right-hand side, once we start to add in insurance, we're adding in additional price increases, which means that net operating income, the difference between revenue and expenditures, is getting smaller. We're pulling in more money from this asset. And then we also end up adding on, because it's a riskier property with more insurance added onto it, we end up increasing the cap rate. We add an additional risk premium onto it. So we want to understand as we're looking at what the difference in those revenues and expenditures are we actually able to make a sound investment? It's a risky investment. Let's increase the risk premium a little bit to make sure that we can, it makes sense from a business perspective. So this is an example of an average home in California. In California, if you go to the Census Bureau, the median cost of renting across the state's about $21,000 a year. The average cost of homeowners insurance is about $1,400 a year. The average cost of insurance on the fair plan is about $3,200 a year. The other ownership costs, on average, about $4,700 a year for regular size single family home, and then our normal cap rate's about 5%. And then we also price in here, or we work into this, the increases in wildfire risk over this time period, which is about 58% across the state of California. So just looking at the model and the table that we have set up here, the current column over here on the left-hand side tells you what the situation is today. Again, annual rent is about $21,000 per the Census Bureau. Homeowners insurance is about $1,400. Other ownership costs are about $4,700. That means the net operating income is about $14,000 for this property. It's the revenue from the $21,000 minus the $1,436 and the $4,734 gets us to that $1,400, number. You divide that by the cap rate of 5%, and you get a property value of $296,000. If you go to the Census Bureau, you look at the average single family property value, it's about $300,000 in the state of California. So this, again, this is a very rational approach. It's a super simple approach. We're simplifying the value attached to each of these properties, but it ends up working out really well. If you just take real numbers that we know are associated with expenditures and revenues, we're getting an asset valuation that's on par with what we're seeing reported out in sort of authoritative numbers. If we move to the second column, the repricing after insurance adjustment in 2023, the only thing we're doing is on the second column, we're adjusting our insurance from the state average to the state fair plan average. And so that difference in the state average versus the state fair plan average it ends up being the increase of individual properties being moved off or getting essentially a non-renewal from their insurer and having to move over to the state fair plan. And so by simply adding that increase in cost, about $1,800 or so, your everything else stays the same. Other ownership costs stay the same, revenue stays the same, but your net operating income decreases. So now our net operating income is about $13,000 instead of $14,800. If you divide that same net operating income by the cap rate, you get a new asset valuation that's at $261,000. So now our asset value, by simply including this additional home insurance cost and increasing from $1,400 to $3,200, we've decreased the asset value from almost $300,000 down to about $260,000, or about an 11 or 12% decrease. So the title, I think, puts this really succinctly. It says the average home in California that receives a non-renewal could instantly lose about 12% of its value. So, and we already saw that there's some zip codes where up to 11%, 1 in 10 properties are being hit with these non-renewals. And from this asset valuation perspective, they're immediately then being hit with property devaluation due to the fact that they have additional expenditures associated with that property. So we on the last column, we've adjusted everything up to the future 30 years. We've increased the 58% risk premium based on the increase in wildfire risk. And so you see that here, the $3,200 to the $5,400 dollars. That's a 58% increase in cost. We haven't adjusted any other dollars. We know that inflation will happen. The dollar will be worth different. The dollar won't be worth what it is today in 30 years. But this gives us the ability to isolate the effect of climate. So we're saying if we only look at the effect of climate, we say in today's dollar, we increase the risk by 58%. We know this is a riskier property, so let's also increase the cap rate by 1 percentage point. So we're going from 5% to 6%. Now the net operating income drops to about $10,800. We're dividing it by a higher cap rate, and we end up with an asset valuation metric of about $180,000. And so in this case, from our $300,000 value today, we're losing about 40% on that. If we just think about current adjustments to insurance costs and then hypothetically pricing in future risk. So it starts to give us the ability to understand how is this impacting properties in a more tangible way than just the intersection of our wildfire model with those properties. Oh, sorry. Okay, so and unfortunately, it's not just happening in California. We're seeing this in a lot of different places. There are three places in particular that are probably ahead in regard to the risk that we're seeing in those areas and the ways in which the insurance market is responding to that risk. So California, of course, we've talked about Florida, which we'll talk about in a little bit, but then also Louisiana. Just this year, the insurer of last resort in Louisiana, which is primarily wind-driven, is home insurance citizens, the insurance program there, increased their rates by 63% across the board. And unlike California, where we were looking at people getting moved from private insurance onto the state-backed or the state-run plan, now we're looking at these properties in Louisiana that are already on citizens. They've already been moved to the insurer of last resort. The insurer of last resort says, wait a minute, our rates are too low. We need to adjust the rates. As of January of this year, they've increased the rates by about 63%. So across the state, you're seeing that risk increase. There's certainly some spatial patterns. The southern tier is seeing a larger increase than the northern part of the state, which makes sense. You're right along the Gulf. We see intersections with sea level rise, direct impacts from hurricanes, more flooding, more wind exposure. So the exposure is stronger and higher in the southern tier of the state. But it in some places, around the New Orleans metro area, for instance, St. John the Baptist saw an 83% increase, almost a doubling of insurance just on January 1st of 2023 from the rates that were already pretty high, given the location and the fact that it is the insurer of last resort. And then in Orleans Parish, we saw one of the most populated parts of the state of Louisiana. We saw an increase of about 76%. So it's happening across the board. It's primarily driven by wind and wind exposure. But these, again, are properties that were already on the insurer of last resort. And we have to remember that unlike parts of California, where even the average home value was about $300,000, the property values in Louisiana are much more modest. So these increases end up impacting the bottom lines even more, at least disproportionately, than they would in California. So Ed, I think you wanted to talk through the wind model, given that that's the exposure we see in Louisiana.
Yeah, I'll just explain a little bit about that. So, we have modeled flood, wind, wildfire, and heat so far. We are working on air quality and drought next. So I'll just say a few words about our wind model, so you can understand where these numbers come from. So we've based our probabilistic wind model. It only is considering tropical, cyclones, so tropical storms and hurricanes. And we are looking at a group of storms that in a method pioneered by Dr. Kerry Emanuel from MIT, who started using this technique back in 2006, 2007. One of the things that was very hard about hurricanes when you're studying them is there's just not that many hurricanes, particularly not that many severe hurricanes, in order to do statistical analysis. So Dr. Emanuel had pioneered a way of creating synthetic hurricanes that are seeded in the global circulation models that are driven by the climate models. So we can see, are there changes in patterns that we can anticipate in hurricane path, in hurricane intensity, in hurricane duration, and that's what we've used. So we've, rather than rely only on the historical record that is only dozens of hurricanes, we analyze a suite of landfalling hurricane tracks of about 58,000 storms, and we're able to discern the changes that climate change is bringing, that the climate models say that will have impacts on hurricanes. And it's mainly that hurricanes are going to be a little bit stronger. Not that there's going to be more hurricanes in the future, but those hurricanes that do form are more likely to become stronger, which means also they're going to penetrate. These high winds will penetrate further inland. That's a very important part of this analysis that you'll hear. And the other piece is that there's a slight shift northward in the tracks. So that's really good news if you live in South Florida. Not so good news if you live up in Jacksonville or further up in the southeast. But there's a little shift in the risk going a little bit further north. So that's the model that we're using. And again, for all of our models, and thank you for keep those questions coming in. We'll get to them. A lot of questions about technical questions. I urge you all to go on to our website at firststreet.org. We've got all the details of all the methodologies of all these different models that we're using. because everything we do is open and transparent. We want to communicate how we're doing all this. So I'm not sure if we'll get to all your all your technical questions in the Q&A, but I just wanted to mention that if you do want to go peruse the technical documentation that's online there, and a lot of those documents are on that have been peer reviewed also too. They're links out to the scientific journals in which these reports have appeared. Back to you, Jeremy.
Great. Yeah, that's a great point. Something that we probably should have raised earlier, but all the models, all of it, even our implications research, goes through the peer review process. We have technical reports available on the website, and we also have we publish through open access as much as we're able to. So you'll have access to the journals themselves also. So that's a terrific point, Ed. And if we're just leaning on what Ed was discussing around the wind model, we think back to the Louisiana increases in insurance. Here we can actually see the increases. That's sort of that 63% increase in home ownership. On the left-hand side, we went back to the same resources that we used for California. The median cost of renting in the state's about $11,000. So already you're seeing the differences in revenue, the differences in costs across the states. The average cost of homeownership in Louisiana is about $2,500. The average cost of homeownership scaled again by 63% is the increase this year that we just saw on average across the state. Other homeownership costs in Louisiana about $2,500. The normal capitalization rate, again, we hold at 5% until we get into the future case where we raise it again with the additional risk premium to 6%. And if you look at the models, you can actually see the revenue over expenditures. Again, we're talking about revenue of $1,100. Homeowners insurance is about $2,500. Other building costs also about $2,500. Net operating income in this case is about $6,000. Divide that by the cap rate, you get about $121,000. That's about the average property value across the state of Louisiana. So it ends up, again, working out pretty well from just a purely asset valuation perspective. Again, we always wanted to note here with the caveat that we know that people that live in these communities don't think about, I just got an increase in my insurance costs. My property must have gone down by 20%. You know, they're thinking about it in different ways. There's more sentimental ways to think about it. But from a purely rational asset valuation perspective, this model on the current side ends up working out really well. If we end up adding just that additional risk, the additional cost of insurance here. So we scale it by 63%, given the increases that happened in the Citizens program in January of this year. We can see that lowers the net operating income from $6,079 to about $4,500. This is a relatively, I mean, it's a pretty significant drop, especially when you think that the net operating income was only about $6,000 and now you're down to $4,500. So that decrease is captured here in the property valuation now at about $90,000 or about a 26% drop. So this increase of 63% on just the insurance cost alone decreases the asset value by almost a quarter of what it was. It goes from about $120,000 down to about $90,000. Again, if we scale that into the future, so we're just doing the same thing we did in the California model. Here we're looking at the increase in wind exposure moving into the future. So the increase in wind exposure ends up increasing the cost to about $4,700. It's an additional hit on the insurance. It does lower the net operating income to about $3,700. We've added the additional risk premium to 6%, and by just again adjusting in the current adjustment with the updated insurance cost, and in the future adjustment with just the increased risk, we see in a property devaluation of about 48%. So you go from a property value of about $121,000 to about $63,000. So it's a huge drop. We know again that we're not scaling numbers. All we're doing is holding risk, or all we're doing is allowing us to isolate climate in these future-facing models. Excuse me. Okay, and so the third place that we really called out in the report was in Florida. So we know that the other place where we're seeing a lot of activity around the insurance market, a lot of news coming out around the market is in Florida, in California, primarily driven by wildfire, in Louisiana, primarily driven by wind. In Florida also, the Citizens program driven by wind, although there's a new state mandate now that is requiring every property owner that moves on to the Citizens plan to also have flood insurance. And predominantly, that's going to mean having some kind of an NFIP policy. And so the way that it's structured is that January 1st of 2024, any property that is insured for $600,000 or more is going to have a FEMA insurance policy along with the Citizens Wind insurance or home insurance policy. In January of 2025, it's for all properties 500,000 or more. January 2026, all properties of $400,000 or more. And in January 2027, all properties that have a Citizens home insurance plan are going to have to also have flood insurance attached to it. And if you just look at the trend line that we're looking at here, up until about 2021, there were about 500,000 properties on the Citizens plan. After 2021, we've seen that grow substantially. We're up to about 1.3 million properties. There have been forecasts in the news recently that we're headed towards 1.7 million pretty soon, but there isn't an expectation that's going to reverse anytime soon. So having the increase in the number of policies also have to now take on a flood policy as a condition of having a Citizens home insurance policy isn't being significant, because now you're not only getting hit with the increase in cost associated with moving to the insurer of last resort, but you're also having to add on to that an additional cost associated with a flood insurance premium. So if we looked at Florida, again, the median cost of renting about $18,700. The average cost of home ownership is about $2,400. In this case, we focused in on Palm Beach County. The average cost of Citizens in Palm Beach County is about $3,500. The average cost of flood insurance in that county is about almost $1,200. Additional home ownership cost is about $4,200. And then the adjustments that we're seeing in regard to the increases in wind in Palm Beach County, there's an increase of about 7.5%. And then the increases in flood costs, and this comes directly from FEMA. There's a current rate, and then there's a rate that the rates are moving to under risk rating 2.0, which was an adjustment that took place in the last couple of years on flood policies that's also impacting these homeowners. So they're getting hit with both the increase in wind exposure and the continually increasing cost of flood insurance under the NFIP program. Again, we've set the cap rates the same, 5% currently, 5% with the insurance adjustment, and then 6% as the asset becomes riskier with the additional climate risk. So again, $18,000. Homeowners insurance is about $2,400. Other building costs about $4,200. Net operating income is about $12,000 for if this were an institutional investor looking at this property. Divide that by the cap rate, you have an average property value of about $240,000. Again, about the median property value for a single family home in the state of Florida. And if you adjust currently for the movement from homeowners insurance to the Citizens plan, and you add on the current NFIP rate, you end up decreasing that net operating income to about $9,700. Divide that again by the cap rate, the property value or the asset valuation drops to about $195,000. So right away, we're losing about $19,000 in asset value. Again, we're getting the double hit here. We're assuming that these properties are taking on both the additional cost of home insurance from the Citizens plan, but also taking on the additional cost from the flood insurance plan. And if we just scale that into the future for climate risk, which come from our wind and our flood models, then we're essentially decreasing the net operating income to about $8,500, $8,600, divided by the cap rate with the additional risk premium, and our asset value drops to about $143,000. So then we're losing about 40% or almost $100,000 on this $240,000 asset. So Ed, maybe you want to talk about the flood model for a minute.
Sure. Yeah. Thanks, Jeremy. Yeah. So a little bit of technical description of the flood model. We'll be describing some of the impacts of this next. So the flood model, those of you that have been following First Street over the last couple of years know that the flood risk was the first product that we released back in June of 2020. We're now on the third version of this model. And what we are doing, this is a compound risk model. This is looking at contributions from sea level rise. from storm surge, from heavy rainfall, and riverine flooding, all combined into one exposure estimate. So it's like one-stop shopping for how much flood risk you're going to have at any property across the U.S. This is our highest resolution product. This is a 3-meter product, and for the exposure, and so we can discern property to property as well as within property flooding. So we calculate the exposure of every building, the footprint of every building, of whether water is going to reach that footprint and water is going to be getting to that house or not. So we bring all these together. One of the big improvements that we've included in version 3 of our model is the impacts from heavy rainfall. So these are the kind of flooding that we're seeing in Brooklyn, New York today. We've seen this repeatedly across the U.S. We continue to see these heavy rainfall events that are catching communities by surprise. One of the reasons is, well, number one is that FEMA does not include heavy rainfall in their definition of a significant flood hazard area. And that's a fine point that is lost on many Americans. They think that they're not in a FEMA designated flood zone, so they don't have any flood risk and they don't get flood insurance. Why we're talking about insurance so much is this helps create a more resilient nation, a more resilient community, protects people against environmental risk and climate change if they have these things, right? So if you don't think that you need flood insurance and you don't buy it, then when you do have a flood event, then you're caught unawares, and you could have significant financial impacts on you and your family. So we're trying to call attention to this. So by including the new estimates of precipitation intensity, duration, and frequency, which we have computed at First Street, we've computed using the last 20 years of NOAA rainfall data, looking at that and using the same kind of methods that NOAA traditionally has used in developing rainfall climatologies. We're able to discern a big shift in that rainfall intensity, and that's causing additional risk, particularly in the Gulf Coast, through the Ohio Valley and the Northeast, but also in some areas out west. So what you're seeing here in version 3 of our flood model are all of these flood impacts being integrated together. But that heavy rainfall component, like I said, which we continue to see communities in the U.S. be surprised by these heavy rainfall events. We're trying to call attention to this and make sure that people realize that they do have this level of risk at their property, and they can start to do something about that. That might be insurance, that might be elevating their home, that might be creating other types of protections for their home, but they're not caught unawares that they're living with this kind of risk today, and that this risk is going to, in most places in the U.S., continue to increase over the next 30 years as climate change makes the air warmer and you can fit more water vapor into the air. The rainfall events we have are going to be more intense. So with that said, Jeremy, I'll throw it back to you.
Yeah, and I'll just add a couple things on this slide. Is the improvements on our version 3 of the flood model, as Ed mentioned, updated the precipitation estimates, which are really the primary driver of the new model. There are other things that were updated, new climate models and other updates, but that improvement on the precipitation model means that we are bringing precipitation records for the first time into the current environment. I think before this, we were relying on NOAA Atlas records, which when you look at the methods and you go back and estimate for instance, the 100-year rainfall depth, we were actually looking at an environment that occurred 50, 60 years ago. By bringing that forward, we're actually finding, for instance, as Ed pointed out, in the Ohio Valley area, the 100-year flood depth happens about every 8 years. If you come into New York, the 100-year flood depth occurs about every 30 years. So that increase in exposure also meant that if you look at our risk from our 1 in 100-year flood model compared to the FEMA special flood hazard areas, which admittedly they admit don't include small waterway flooding, don't include precipitation, we're finding about 2.2 times as many properties across the country with 1 in 100-year flood risk than are actually in flood zones based on those public-facing flood zones.
Yeah. And I should also mention, Jeremy, that Dr. Jung Ho Kim, our senior hydrologist at First Street, all of his work on the creation of the precipitation climatology has also been published, and it's also available at the website if you want to learn more.
Yeah, and it's and in our previous report, the precipitation problem also. And why is that important? It's important because, as we mentioned, There's so many more properties that have risk across the country than are in these FEMA special flood hazard zones. But the way that flood insurance is mandated from the federal government, only properties within those special flood hazard areas are mandated with a federally backed mortgage to have a flood insurance policy. So those flood insurance policies across the country, if there's 2.2 times as many properties, over half the properties with significant or 100-year flood risk across the country don't actually know they have that type of flood risk. And we see what we've seen in West Virginia, in Kentucky, in some of these places that are precipitation, where flooding is precipitation driven, but there's not a lot in the way of flood zones for that type of risk. And why it's important is the current NFIP rates are taking, or the future facing, NFIP rates per the risk rating 2.0 adjustments, which was the first adjustment on the premium algorithm for the NFIP since the early 1970s when it was first set up, are now taking into account risk-based information in calculating those premiums. It's not just are you inside or outside of the flood zone with some characteristics attached to it. Now there are underlying models that are driving risk rating 2.0 pricing algorithms that look a lot more like our risk-based flood model. So if you start to look at those and you see the prices and the price increases that are coming out of the NFIP and coming out of FEMA, these data are directly from FEMA. In Plaquemines Parish, Louisiana, we saw the largest increase. There, the current NFIP rate's about $840. The full risk-based rate, once the full price is priced in to the flood insurance premium, is going to be about $5,400. For those that already have a policy, there's a glide path. There's an 18% increase year over year. But if you just were to jump to the full risk-based rate, they would go up by about 550% on their flood insurance cost. And all of that, again, is associated with the fact that the increases in risk that are climate driven we're seeing more likely and more extreme precipitation events, and we're seeing not necessarily more, but we're seeing stronger hurricanes that are again driving a lot of this risk in these areas. And so we'll take that information. We ended up plugging it in. I'll go through this pretty quickly. The same process that we went through for the other states. Here, if you just look at the NFIP in Louisiana, annual rent's about $16,500. Homeowners insurance is about $2,500. Flood insurance is about $8,042 if we're talking about Plaquemines Parish. The net operating income is about $8,400 divided by the cap rate. We have an average property value of about $170,000, which is on par with what we see in that area. If you just increase the cost of the NFIP policy to the full risk-based rate that NFIP released or FEMA released, right away you're seeing about a 50% decrease. And if then you scale that forward to the increase in risk in the area in Plaquemines Parish, for those that don't know, it's the very southern tip of Louisiana. It hangs out over the Gulf of Mexico. The increase about doubles moving into the future in terms of flood risk. For a property that is only worth about $170,000 today, if you have a homeowner's insurance policy of $2,500 and you're paying over $11,000 in flood insurance, from an asset valuation perspective, the property, it just doesn't make any sense. There's no value attached to it. An institutional investor wouldn't invest in it. Again, that doesn't mean that somebody that lives there wouldn't see the value in it and wouldn't understand that there's more to it than just the asset valuation approach. But it does get to the point to where, from a financial and economics perspective, we start to look at these properties and they essentially become uninsurable. It doesn't make sense to have a property that is worth that amount that takes on about $14,000 of insurance. So we took all of this information from our flood, our wind, our fire model that Dr. Kearns has walked through. We went around the country. We found that there's about 6.7 million, almost 6.8 million properties that are already on these insured of last resort plans. And so we found some in Oregon, we found some in Texas, we found some in Arizona. In the Gulf Coast, we found programs in Mississippi, South Carolina. So there are these programs that exist across the country in these high-risk areas. And we found that already about 6.8 million properties have been pushed onto these insured of last resort plans. If you just take the risk profiles of those properties that have already been pushed onto the insurers of last resort, or in the case of flood, are already seeing rising increases in costs due to the recent adjustments of risk rating 2.0 in the NFIP, we're finding about 39,000 properties, or 39 million, sorry, properties across the country that have this same level of risk or this same risk profile. There are almost 12 million properties that have 1 in a 100-year flood risk that aren't on current NFIP policies. There's only about 4.7 million properties across the country on NFIP policies. In terms of wind, there's almost 24 million properties that have the same level of risk or the same risk profile across the country that we see for the properties that have already been pushed to the wind insurer of last resort, predominantly in Louisiana and Florida. And then on fire, we see about 4.4 million properties that have the same wildfire risk profile that we see in California, where we've seen these properties, these 336,000 properties pushed onto the state fair plan. So in doing this, what we're really doing is we're trying to quantify what is the size of we're calling it the insurance bubble. It's a climate-driven insurance bubble. There's overvaluation that exists in these properties. In some cases, it'll be a very, very small overvaluation, maybe a 1% overvaluation, or like on the last slide, in some cases, total devaluation. So there are about 39 million properties that have some level of overvaluation and exist in this climate bubble due to the risk profile that we find in our wildfire, our hurricane wind, and our flood models. And so we released the report back last Wednesday. On Thursday, we actually saw Executive Order N1323 came out of the state of California. Good news in the state for the adjustments of the regulatory policies, where private insurance companies weren't able to operate in an actuarially sound manner, given the price restrictions and the increasing risk and economic cost. But Governor Newsom essentially said that ordered, I guess, through this executive order, the insurance commissioner in the state to include climate in the pricing of premiums and allow private insurance companies to do that. In response, Commissioner Laura confirmed that he will allow insurance companies to consider climate change. There are some restrictions and conditions they're still figuring out. They're going to require private insurance companies to also price premiums in high-risk areas and carry a certain quota of premiums in those high-risk areas. But the news here is that the regulatory restrictions that were driving insurance companies out of the state are now being worked on and potentially will allow for the private insurance market to take some of that risk away from the state and essentially take some of that risk away from the taxpayers. So we almost ran up on time, but I wanted to let everybody know the reports, the materials, all the data that run all of these analyses, the underlying hazards, they're all available at our website. As Ed said, a lot of the documentation around all of these different materials are available at the website. You can email us directly if you have specific questions or you have interest in any of these materials, data, underlying hazards, any of that kind of stuff at info@firststreet.org. And it'll come directly to us. We'll be able to respond to all of those. I know I think Ed and Matt were responding to questions as they come in. I apologize that we ended up pushing the full hour this time, but we'll continue to collect questions and respond to those.
Yeah, we couldn't keep up, Jeremy. We've had over 260 questions coming in rapid fire. So what we'll do is we'll record all of these questions and we'll answer them and post them along with the slides and the video. We'll get answers to everybody. So apologies that we didn't have time to get into all of this, but there's some great questions in there and we will get you some answers.
All right. So I don't know, Matt, if you wanted to say anything or close. I know you popped on. We appreciate everybody for jumping on, and we had a tremendous turnout for the webinar. A lot of interest in the report and the research that we're doing. Reach out to us. We're happy to engage with you. We're happy to talk with you about our data, about our research, to share materials with you. So Thanks,
Yeah,
everyone.
that's it. It's exactly right, Jeremy. And thanks, Dr. Kearns and Dr. Porter, for the great presentation as always. As Jeremy was just saying, please email us at info@firststreet.org if you have any questions. And thanks to the thousands of you that joined. It's our these webinars keep growing and growing, so it's amazing to see the interest, and we love to provide the data for you folks. So thanks for the questions, and we'll be in touch soon with all of you.
Thank you, Earl.